Okay, so good evening, channel. Today I accepted a challenge. Lately I've been listening this a lot, which is the idea of explain me your business in 1 minute. Let's see if you can explain what you do in 1 minute. So I accepted that challenge, and why we're profitable and things like that. And I came up with this idea, and this is gonna be my 1 minute video. Okay, my 1 minute explanation for TikTok brains. Okay, so basically, and my minute start right now. If I had to explain in 1 minute what I do, is that, for example, when you are buying stocks or businesses, you have things that are $1 on the dollar. We can explain it this way. A way of seeing this is, for example, when the market cap of a business is, for example, 40 million, and then when you see the assets free of debt on the balance sheet, you see that they have $40 million in the balance sheet. So this is a business that's $1 on the dollar, basically. Okay. So what's the meaning of this? Because I'm not gonna explain you all the things that go inside understanding balance sheets, because for that we need a 10 minutes video, of course, and this is for TikTok brains, not for people that want to study. So $40 million free of debt means $1 on the dollar. What's the meaning of this? The meaning of this is that if this business decides to go out of business, close operations, sell everything, okay, and pay a final dividend to shareholders, or isn't even a final dividend, it's a liquidation of the company, it means that you're probably going to lose money, because it's $1 on the dollar, but then you have to pay lawyer fees, liquidation fees, wait time, a lot of fees, and then the money that's remaining, let's say 20 million, okay, will go to shareholders, right? So basically here you lost 50 cents of each dollar. So coming from this explanation, what I do is simply the following move. In stocks you can buy so many businesses at different valuations, and you can buy a very expensive business and be right about it and make money. However, the strategy that many college professors recommended, the father of value investing and many other people, is that you buy things for cents on the dollar. That's the name, cents on the dollar. So for example, instead of buying something that's $1 on the dollar, you buy something that's 30 cents on the dollar. When business starts being undervalued, meaning the stock goes down in price, you start finding businesses that perhaps have a market cap of 30 million, but in the balance sheet you can see that they have $100 million of assets free of debt, basically. Okay, so that means that's 30 cents on the dollar. The meaning of that is that if the business goes to liquidation and closes, which is something that usually never happens if you are buying sort of quality businesses, you're probably going to make money, because after paying the lawyers, after paying the liquidation fees, let's say only 80 million is remaining, okay, instead of 100, you're gonna double your money. Okay, so sometimes businesses and stocks get so undervalued, so the price is so low that it's even convenient for people for the business to close. So you have many shareholders that got into the business so cheap that it's more convenient for them that the business closes than the business paying dividends. Okay. However, that's only an hypothetical case. That doesn't happen. The business tries to stay in business. If you got to the point of being a publicly traded company, obviously you love what you do, you know how to do it, and you try to stay in business. Okay, so usually the business tries to stay in business and keeps paying dividends and so on. Okay, so the last interesting observation is that you can find undervalued businesses, let's say 30 cents on the dollar. This is a simplification. Usually you're going to have, I don't know, business with 37 million and 180, things like that, you know. Reality is not round numbers. But the interesting thing is that sometimes you have undervalued businesses that are undervalued because the business is struggling. They are losing money, their products are not selling, or they're waiting for a new drug to be approved. So many reasons for the business to be undervalued. In some cases, the market is right about the price being down because the business is struggling. So they're going to keep losing money and this is going to continue decreasing, right? But in other cases, the market is wrong. In other cases, you have businesses that are undervalued and that they are still profitable and they are still paying dividends and they are still good businesses and they have a decent business model. And perhaps right now their earnings look like this, are not increasing, but that doesn't take away that maybe next year or in 5 years, they will continue to grow. You know, if they grew to the point of being a publicly traded business and a publicly traded stock, okay, why they cannot continue growing in the future? Maybe they just need 2-3 years, you know. So basically that's what I do in one of my funds. Then I have other ones with different strategies. But this strategy, this approach, it might kill returns, you know, in the sense that you win less, but you increase your safety, you increase your margin of safety. And even if there's a market disruption, some event that makes company go broke, in many cases, you end up holding stocks that pay you more money than what you spent to buy those shares. So that's basically it. That's how it works. You know, it's buying cents on the dollar, buying undervalued. Okay, and then in the portfolio, sometimes, let's say I buy things at 50 cents, at 50 cents instead of 30 cents, because the 50 cents in a dollar business is more exciting than this one. You know, perhaps this one is more undervalued and still is profitable, but I pay a little bit more for this one because they have an interesting business model that might turn around and they might increase my returns substantially and make me close another year with great returns. You know, last year we did 72.3 without leverage, which is an incredible result. And that's basically it, trying to explain it in a few words.